Welcome to Real Estate Live, where your questions get answered. We go live twice a week about the hot topics everyone is asking about. We go live at 9 a.m. Pacific time on Monday and Friday. I'm your host, Andrew Finney with King Realty Group in beautiful Las Vegas, Nevada. Today's hot topic is all about the 15-year versus 30-year mortgage. Which one's better, and how do you know which one is right for you? To tell us more about this is Celeste Harvey with Fairway Mortgage. She's going to give us the scoop on the inside track of the 15-year versus 30-year mortgages, plus today's mortgage market updates and today's mortgage rates. And then she's even going to hook you up with a bonus session and walk you through how to complete a mortgage pre-application. Let's go ahead and bring Celeste up and let's get after it.
Hey, Andrew. Good morning. How's it going?
Good to see you. It's good to see you. Happy Margarita Friday. I already know, right? It's Friday.
Yes, to all my YouTube friends, happy Margarita Friday. Woohoo.
Fantastic. Well, Celeste, we appreciate you joining in today, and let's go ahead and hop right into it with today's mortgage rate updates, please.
Perfect. So if you could share the screen, Andrew.
Sure thing.
Okay, guys. So mortgage interest rates today, we can see we're down about 6 basis points here. But we want to keep in mind that we are above the 50-day and 25-day moving averages. So we did see an improvement in mortgage interest rates this week. I know last week, the last time we spoke, we saw a little bit of a decline in rates. So we did see an improvement. And you might be wondering, well, why did we see an improvement? Well, basically, the Fed came out with some information this week. They made an announcement, and they basically stated that they are leaving rates unchanged at 0 and expect to remain at 0 through 2022. When I say rates, I'm talking about the Fed funds rate. And remember, we've talked about this before. The Fed funds rate does not directly impact mortgage interest rates. It's more of a short-term rate between banks. But what the Fed said that was important for mortgage interest rates is that they will continue to buy mortgage-backed securities and treasuries at current levels for the foreseeable future. So that's positive news for mortgage interest rates. They also came out and they provided some predictions for GDP, inflation, and unemployment as well. So on GDP, many think we will see a decline of about 6.5% in 2020, but gain back 5% in 2021 and 3.5% in 2022. The unemployment forecasts were about 10% for the fourth quarter of 2020, 7% for 2021, and 5% for 2022. They also predicted there to be no inflation in 2020, around 1.5% in 2021, and less than 2% in 2022. So this really just shows that, you know, we are going to have a slower comeback in the economy, but it's a good sign for mortgage interest rates. And also keep in mind, it's going to be a faster comeback than, you know, the financial crisis and also the Great Depression as well. Something else that happened this week as far as news goes, the coronavirus, there's news that COVID-19, maybe a second wave might be coming as we're starting to emerge from lockdown. So you can kind of see that there was a lot of volatility, you know, in the stock market. And we can go ahead and show that chart here. We saw a decline in the stock market in some industries, so that wasn't doing so hot. But you know, the mortgage bonds were doing a lot better this week. So I would say, you know, my prediction for the next 6 months to a year would be that we're going to continue to see historically low interest rates, but keep in mind that there can be pockets of volatility.
That's really interesting. And for everybody that's watching right now, first of all, of course, thank you for joining in. And if you're catching us after the live stream, thank you for being here. What's really cool that Celeste and I did is we actually gave her access to share her screen. And so we've been working on it behind the scenes. And the screen that you see in front of you right now is called the MBS Highway. So with an MBS Highway, it's a specialized tool that loan officers have access to, and these charts update real time. So when you see fluctuations, this is the market, and this is what lenders are looking at whenever, if you're like in the home buying process right now, and lenders are giving you a call and say, hey, we need a lock. This is the stuff that they're watching real time. So when you wonder what a loan officer does behind the scenes, it's a lot of watching the market and the movement in addition to assisting you and helping you find the best loan terms for you. But in reality, and seeing the truth as transparently as possible, these are the items that really impact and count what kind of rate that you're going to end up being able to get on a specific day when you rate lock. So Celeste, thank you so much for sharing the inside track here with this real-time screen. I love it. I absolutely adore the screen. So that brings us into the mortgage market update. Celeste, what kind of updates do you have for us specifically with mortgage market updates? What are you seeing? What are you hearing? What's going on?
That was the mortgage market update, the information regarding the Fed. I gave it to you all at once. With, the fear of the second wave of COVID-19, how that, is impacting mortgage interest rates, how that's impacting the stock market. So it's something that's going to be really interesting to follow over, the next 6 months to a year. But overall, with the Fed purchasing mortgage-backed securities and treasuries, at the current levels, we should continue to see, historically low interest rates. So I don't think we should, necessarily see a huge spike in interest rates anytime soon, but keep in mind, there can be pockets of volatility.
Very good. Thank you for that. So one of the curiosities that I'm wondering about as far as another, like maybe more meaningful impact to the mortgage market is just how many home buyers are you seeing do applications right now, get approved and go in the home buying mode? Because on the real estate side, I'm noticing that a lot of homes that may have lingered a little bit with the stay-at-home orders are popping off the market like it's insane. And there's not enough homes replacing them. We were already at low inventory, and there were some sellers that have pulled their homes off the market at the same time that buyers were backing out of the market with the stay-at-home situation, right? But now that everything is starting to reopen and buyers are coming in with force, people have been returned to work, they're able to get their home loans again. What I'm seeing is anything that was on the market that was nice, gone, gone. So what are you seeing on the application side? Because I believe that's a strong indicator of not only the demand, but also where the real estate market and mortgage market is likely to go as we move forward.
So basically what I've seen on the application side, I know last week, I think it was last week or the week before, mortgage applications were up by about 9%. So that's a huge indicator to just state that, and these are purchase applications, to state that buyers are coming back to the market. But what I've seen personally in my business is definitely an uptick in purchase applications. I have pre-approvals out there. I have people out shopping for homes right now, and it's not easy. It's not easy for them to, get an accepted offer. There's usually at least 2 or 3 other offers on the home. So it's definitely a difficult climate, but I would say, it's a really great time to purchase a home with an affordable interest rate.
Yeah, this is true. So now let's go ahead and go right into our hot topic, because I know you were super excited to share the differences between a 15-year and 30-year mortgage. What's on your mind and what can you tell us?
Okay.
Maybe I want a 15-year mortgage. I don't know. Tell me. Maybe we'll decide here if I need to refi into a 15-year.
Let's do it, Andrew. I'd love to help you out. So if you could share that screen again, I have some graphics here. Can we see this? Oops.
You can control plus it if you want.
There we go. Oh, okay. Sorry, guys. I'm figuring this out. It's my first time. So a lot of people always ask me, should I do a 15-year term or a 30-year fixed term? And I always tell people it really just depends on your specific situation, because there are pros and cons for using a 15-year fixed mortgage and a 30-year fixed mortgage. So we can look at some of the pros and cons that I have listed here. Some of the pros for a 15-year fixed mortgage is you'll most likely have a lower interest rate. You'll be able to pay off your mortgage faster, and you'll pay less interest over time. Some of the cons, you'll have a higher monthly mortgage payment. It'll be significantly higher than a 30-year fixed mortgage payment. It might be a little bit harder to qualify for a 15-year fixed mortgage loan because with a higher mortgage payment, that will increase your debt to income ratio, making it a little bit harder to qualify, and it might even reduce your purchasing power. So you might find, oh, with a 15-year mortgage, I only qualify for maybe $200,000, but with a 30-year mortgage, maybe I qualify for $300,000. So that's why I say it really depends on your specific situation, what your debt to income ratio looks like, how much money you're putting down. But a 30-year fix, is also great. Some of the pros of that, you're going to have a lower monthly mortgage payment than a 15-year fixed mortgage. You'll have more purchasing power because your mortgage payment is going to be lower. It's easier to qualify for a 30-year fixed mortgage versus a 15-year fix. Some of the cons, it takes a lot longer to pay off. It takes 30 years to pay off, where a 15-year fixed mortgage takes 15 years. So with that, you're going to pay more interest over 30 years than you're going to pay over 15 years. So what I really want to do is show you guys an example. But first, I want to point out that, this illustration is based on a conventional fixed rate loan amount of $291,000 and a credit score of 740. This illustration is intended for informational and educational purposes only and should not be relied upon by you. Actual payments may vary based on individual client circumstances and market conditions. So now that I got compliance out of the way, let's go ahead and chat about
the rules.
The rules, yeah. Chat about this illustration here. So you can see this is based on a $300,000 purchase price. So that's the price of the home. That's what it costs. We're only putting 3% down. So this would be a first-time home buyer. And as a first-time home buyer, you're probably looking at a 15-year mortgage versus 30-year mortgage. What's the difference? Well, I kind of listed it out. Here we can see the difference in the interest rate. We can see the 15-year mortgage has a much lower interest rate of 2.75%, whereas a 30-year mortgage, you're going to have around a 3.25% for this example. Both are really great interest rates, so you really can't go wrong there. But next, what we really need to pay attention to is the monthly payment. You can see that the 15-year mortgage monthly payment is $1,974 versus the 30-year mortgage payment is a lot lower. It's $1,266. So keep in mind, this is just the principal and interest. This is not including HOA, taxes, or insurance. So once you tack on all of the other costs, these payments are going to go up. And this 15-year mortgage payment is going to cost you a lot more. So if you're not prepared for a larger mortgage payment, and I know a lot of first-time home buyers, they're looking to reduce their costs. They want to try to keep their mortgage payment about the same as what they're paying for rent. So in that case, a 30-year mortgage is going to look a lot more attractive than a 15-year mortgage. Something else I like to look at is how much equity, how much principal will you have paid down over 5 years? So you can look at a 15-year mortgage, you're paying the principal down a lot faster. Over 5 years, you will have paid about $82,968. You will have paid that much principal off and you'll have gained more equity. Versus a 30-year fixed mortgage, over 5 years, you're only paying off about $30,648. So it's going to take you a lot longer to pay off a 30-year fixed mortgage than a 15-year. And then we want to look at the total interest you've paid over time. With a 15-year, you're going to pay a lot less interest over time. If you're just making the minimum monthly payment, you're going to pay about $68,172 for this illustration for a 15-year. And then the 30-year, it's significantly higher. It's going to be $160,584. So these are kind of things you want to look at when you're figuring out what mortgage term you want. 15 versus 30-year, we got to look at interest rate, monthly payment, how much principal you'll pay down over time, and the total interest you'll pay over the life of the loan.
Those are great points, and it's really interesting to see the numbers put out that directly. And obviously, you're going to save a ton of money on a 15-year mortgage. It's just going to cost you more upfront in the process, in terms of cash flow. But it actually costs you significantly less, over almost $100,000 difference, $92,000 of difference, just to be approximate here, of total interest paid over the terms of a 15 to a 30-year fixed rate mortgage. And those are already at historic low interest rates that you're using here as an example. So I really appreciate you sharing that. A question that would come to my mind is, like, anybody that's watching there in the live stream or anybody that watches after the live stream, is which one would you prefer? Would you prefer to find a 15-year mortgage or a 30-year mortgage option? Keeping in mind that depending on your total debt to income ratios, if you opt for the 15-year mortgage, it may lower the amount of home that you can get approved for because of the higher amount of mortgage going out opposed to the 30-year mortgage. Which one's more important to you? Do you prefer to pay off the mortgage quicker with a 15-year, or do you prefer to get a higher sales price range with a 30-year mortgage and then pay it off quicker over time? Because I know that's a popular question, Celeste, when we're talking about the differences of mortgages. What's to keep me, like I have a 30-year fixed rate mortgage. What's to keep me from paying off my mortgage faster? I can do that, right?
You can do that. Yeah, exactly.
So if I make additional payments onto the principal, I mean, I noticed that on your chart a moment ago, the biggest difference was right up front in that first 5-year period. And that's normally something that we share with families that we talk with and represent, is that 5-year paid equity version is a lot less on the 30-year compared to the 15. But what happens if I say, hey, I'm going to make additional payments onto the principal every single month and hedge off those interest payments and go ahead and reduce my principal balance by doing so?
Yeah, so I actually see a lot of millennials and first-time home buyers out there. They actually opt in for the 30-year fixed program because they want to lock in that low payment. And oftentimes what they'll do is they'll save up money and just apply that to the principal. Maybe every 6 months to a year, they'll just put down a big chunk and pay off the principal. And I always advise them to pick up the phone, call the mortgage servicer, and let them know, hey, I want to make an additional payment, but I want it to go to principal only. If you just make it online, or you don't tell them you want this additional payment to go to principal only, they might apply it to the interest. So it's really important you pick up the phone and you call and you specify where you're applying the money to.
I'm glad that you brought
that up. Do that.
I'm glad that you brought that up, because obviously it would really depend on somebody's mortgage service provider how those options play out. With my mortgage service provider, whenever I go online and want to do an additional principal payment, it actually asks me, do you want to apply this to interest, principal? And of course, you never want to apply it to interest, because that's a foolish endeavor. The interest is based on the principal. So you pay down the principal, you lower the interest as a byproduct over time. So you always hit the principal balance that the interest is being calculated off of. So, if that option doesn't exist in your service provider website, then that's when you want to just pick up the phone, call them, see what's up, and make sure that if you want to make those additional payments, let's say that you got a really big tax return or something coming in, or you got a job promotion. Talk about a great way to use it to pay off your home faster and also gain equity in your house quicker and in yourself. So, I mean, that's freaking awesome. So I like that you brought that up. Now, I know that we're also going to do a demo. I'm really excited for you to demo how to do an application, because sometimes, people get nervous. People get a little bit, scared about the thought of doing it because you're going to ding their credit, and then they're wondering what's going on. So before we do that, I want to get into some of the wonderful people that are joining us live during the stream to acknowledge them, answer any questions that may be popping up. And also, hey, if you have questions as Celeste gets ready to go into the demo portion, we're going to do this like a really fun way. We're going to do this together. She's going to explain what she's doing. And if you have questions, please chime in. We'll pause, we'll answer the question, and then we'll move on to the next step, okay? So leading in with some of the wonderful people that are here with us, Kathy Martinelli, thank you. Kathy says, hi there. Kathy, it's always a pleasure to hear from you, my friend. Thank you for joining us. Claudia, look at Claudia. Claudia's good morning. Good morning, Miss Claudia. Super happy you're here again, my friend. Thank you. Micah, thank you for tuning in. Micah says, morning all. Morning, Andrew. I'm closing next week on the 19th. We are in the home stretch. Yes, Micah, you are. And congratulations. You're getting ready to get the keys to your new home. Super excited for you and your family. Trent says, congratulations, Micah. Kathy's chiming in too, saying, hey, that's awesome, Micah. Clarissa Machulik, thank you so much for joining in, Miss Clarissa. It is great to hear from you. And I recognize that young man's picture. Yes, I do. So Clarissa and her family are some of my wonderful clients here in Las Vegas, Nevada, and they have an amazing family. And it is so much fun to work with them. And I'm glad that you were able to pop on for a moment here with us, Clarissa. Thank you for being here. Mark is, well, here's the thing. Mark is another one of my clients, past clients, and thank you for joining here. But today is a special day. And even though he says, I like cheap mortgages, we know you do, my friend. You like cheap mortgages and a lot of money, and whoever wants to give it to you, right? You're down for it. Venmo, Mark Bedeau, right? Just saying. So it's also Mark's birthday today. So happy birthday, Mark. I know I launched out the text before we went live because I never like to miss anything to do with any of my wonderful families and people that I get the opportunity to assist. So hopefully you got your birthday card as well, my friend. Hopefully I timed it out right. So if you didn't get it yet, should be here today, hopefully. But all the same, happy birthday. I hope you have fun celebrating your special day and you make it memorable. I mean, it's already memorable in the midst of COVID, right? So be careful, be safe, and have fun. Okay, Micah, thank you so much, Micah, for the question. Micah says, is there an interest rate minimum on a 15-year mortgage? I'm about to enter a 30-year due to the affordable payments, but I'm wondering in the future if I can potentially get a 15-year loan lower than 2.5%. And then that was assuming the interest rates go lower than it is. Haha. Yeah. Indeed.
Hey, Micah. Hey, that's a great question. It all depends on the market. It depends on, where the market's at when you're ready to refinance. If the interest rate is available at the time you're looking to refinance, I would say go for it, do it. But if it's not available, then it's just, just depends on the market.
Okay. So thank you for that. Great information there, Celeste. Mark says, I just pay my payment because this isn't my forever home. So I have no interest in paying off this house. If I find my forever home, I would be willing to eat a bigger payment. Great point, yep. Mark. And just so everyone knows, Mark's situation is he's actually active duty. So he's here in Las Vegas area right now for a temporary amount of time. I mean, a few years, maybe even several years. But ultimately, it's not Mark's end destination. So in Mark's case, yeah, that makes a lot of sense. And that's why whenever you purchase a home, you always want to ask your questions to yourself, beginning with the reasons why you're buying a home so that you can gain clarity on what's most important to the home. But then the second question is always, how long are you going to live there? And when you're talking about that, that will answer and help you judge whether you want the 15-year, if it makes sense to you, or whether you opt for the 30-year, and also if you wish to apply additional payments onto the principal over time or not. If you know you're going to be moving in 3 to 7 years, then maybe you don't want to pay it off faster because you know that you're going to be pulling out whatever equity you can get in that property ideally and moving on to your next destination or level up your home, right? Most of us in the course of our lives will actually buy homes 3 to 5 times through our entire lifespan. So our first home is about starting that equity position and gaining equity in our overall life and adding value overall. So Mark, I really appreciate that you share that, because that's a brilliant point, and it really does crystallize the importance of knowing why you're buying and how long you're going to live in that house when you do purchase it. So Mark, thank you for that. Now, Miss Celeste, could you do me a really big favor, please? And let's get your screen up so we can start walking through the home application side. And if anyone has any questions during the live stream while we're popping this up, this is going to be really cool, so you can see exactly what a loan application looks like, and you can ask any questions that might throw you off a little bit along the way, or if you're just simply curious, just hit us up. We'll pop open your question, take a moment to answer it. Celeste, let's go to it.
Okay, guys. So this is my website. You can reach my website by just typing in www.celestehomeloans.com. It'll take you straight to my company website. And every time, I'm talking to a first-time home buyer, whenever I say, the first step is to complete the mortgage loan application, I can tell people get a little scared because it sounds scary, mortgage loan application, but it's really not that scary. It's so easy, and I just want to show you what it entails, what questions we ask, and how easy it is just to do it online from the comfort of your own home. So once you're on my website, you'll see all my contact info here, my phone number, my email. So if you get stuck during the application, you can always reach out to me, even just text message me, and I can walk you through it. But the first thing you want to do is click Apply Now. And when you click Apply Now, it's going to ask you to create a username and password. Once you create a username and password, you'll be able to log in and log out of your application. So maybe if you don't finish it right away, you can always log back in and finish it later. But the first thing it's going to ask is, are you purchasing a home? Are you buying a home, or are you refinancing an existing home loan? Today, we're going to be purchasing a home. And so here it's going to ask for your username and password. I'm already logged in over here. Once you log in, it's going to take you straight into the loan application. And our purpose is purchasing, because we chose that we're going to purchase a home. So we're going to hit Save and Continue. And we're going to go through step 1, step 2, step 3, step 4, step 5, and 6 of the loan application. So the first question it's going to ask, it's super, oops.
Yes, it is a live stream. That was beautiful. We're sorry, this page cannot be accessed. Yes, please re-log in. I think your session may have timed out.
Yeah, it happens. Give me one sec, guys. So it's super secure. You'll see it's going to send me a little code. Give me one sec.
Two-step verification. It seems like the route everybody's going to. There's like two-step verification on emails, Google, YouTube. I mean, they'll access even StreamYard, our serving platform today. Two-step verifications. It's good to have extra security layers.
Oh, now it's asking for my email. I'm sorry, guys. I had this all open, and it must have timed out.
So the importance of completing your application, you'll see whenever Celeste starts getting into it, can actually take about 10 to 12 minutes, I would probably believe, on average. So if you don't complete it in that time frame for the security, it's going to log you out to make sure nobody else is trying to hack you or anything like that. So that's great. It is also worth noting that all of the applications that loan officers use, including the applications that I use at Andrew Finney team, are all on secure servers and all on secure networks. So it is important to know that we take your privacy and your security with the utmost of respect and seriousness. So we ready to continue, ma'am?
We're ready. Sorry, it made me log back in. But as you can see, logging back in is super easy. So the first question is really hard. It's, what is your first name? So we're putting our first name. If you have a middle name or initial, you can put it here. You put your last name here. And keep in mind, we want to put in our full legal name. We don't want to put in any nicknames, because this is the information we're going to use to run a credit report. This is the information that we're using for you to purchase a home. If you have a suffix, junior, senior, you can put that down here. You're just going to click save and continue. Here, you're going to put in your street address. Today, we're living on 1234 Flower Drive. We're in this beautiful city of Las Vegas, and we're in Nevada. And we're just going to put a random zip code in there. So the next question it's going to ask is, do you currently own this property? If you own the property, you're going to select yes. If you don't, you'll select no. It's also going to ask, have you been at your current address for at least 2 years? If you have not been at your current address for 2 years, you'll go ahead and select no, and you'll enter in your previous address. We do need a 2-year history of addresses that you've lived at. In this case, we have lived at Flower Drive for 2 years. So we're going to go ahead and select yes and hit save and continue. We're going to go ahead and let everyone know that we've lived here for 2 years and 0 months. And it's also going to ask you, is your mailing address the same as your current address? If you have a different mailing address that you would like us to mail your specific loan documents to, go ahead and type in that address. If you want us to mail anything to your current address on Flower Drive, then go ahead and just select yes, my mailing address is the same. So we'll go ahead and put in our date of birth. We were born in January 1st, let's say 1999.
Oh, youngin.
Yeah. It's also going to ask, are you a first-time home buyer? And what this question is asking is, have you purchased a home or have you owned a home in the last 3 years? If you have not owned a home in the last 3 years, you're a first-time home buyer. If you've had any ownership interest in a home within the last 3 years, you are not a first-time home buyer. In this case, we've never owned a home. We're first-time home buyers, so we're selecting yes. It's also going to ask if you've served in the military. This is important. This will let us know if you're eligible for a VA loan. In this case, we're going to say yes, we have served in the military. Marital status. Select married, unmarried, or separated. In this case, I'm going to select unmarried. We'll go ahead and put in our phone number. And has our email already. We're going to hit save and continue. It's going to ask for your social security number. We do need your social security number to run a credit report, verify your identity with the Social Security Administration. So go ahead and place that in there. This is important. This is a credit authorization. This is just asking if we have your permission to run a credit report. It's a good idea to hit agree so we can get a credit report ran for you, because we do need a credit report to qualify you for a mortgage loan. So we'll go ahead and select I authorize a credit check, save and continue. Here you'll enter details about your employment and income. It's going to ask, are you self-employed? Are you, 1099? Do you own your own business? If you do, select yes. If you do not, if you're a W-2 wage earner, go ahead and select no. It's going to ask for your employer name. Today, our employer is Chuck E. Cheese. And we live on 123 Cheese Lane. Or we don't live there. That's where we work. We work in Las Vegas. Fun fact, you guys, my first job ever was at Chuck E. Cheese. And yes, I was actually the mouse. I was Chucky. It was a fun job. I was 15 and a half. I had a worker's permit. And at Chuck E. Cheese, we're making $5,000 a month. It's asking for the gross income. So here, gross is before taxes. So what you make before taxes. It's going to ask what my job title is. I'm a manager at Chuck E. Cheese. And it's also asking, have you been with your current employer for at least 2 years? If you have, select yes. If you have not, select no. If you select no, it's going to ask who your previous employer was. We do need a 2-year work history. In this case, yes, we've been here for 2 years. And it's going to ask, how many years have I been with this employer? I'm going to say I've been here 3 years and 6 months. Now it's going to ask home purchase price. Just keep in mind that, this number can change as your loan officer goes through your loan application. They'll go ahead and readjust these numbers, but at this point, you can just put in anything you like. Usually, you're online shopping for homes at this point. So maybe you're looking for something in the 300,000 range.
Or $1 billion.
$1 billion.
Billion, yes.
Then it's going to ask down payment amount. If you don't know, that's okay. Just select, anything from here. Like I said, your loan officer will go in and readjust this and have a conversation with you. But in this case, we know we're a first-time home buyer, and we know we could probably qualify for 3% to 3.5% down. So let's go ahead and choose that. If also we did select that we're active duty military members or we're a veteran, so we would also qualify maybe for 0% down. So keep that in mind.
VA home loan with the
yeah,
VA home.
If you're eligible for the VA home loan, so if you selected that you served in the military, go ahead and just select 0%. If you did not serve in the military and you're a first-time home buyer, depending on which loan program you're in, maybe 3% or 3.5. But like I said, don't worry about it. Your loan officer can adjust that later. Is a down payment borrowed? No, we're not borrowing any money for a down payment. So the next question it's asking is, have you signed a purchase contract? Usually at this point, no, you have not, because we're just trying to get pre-approved. Here you can put your real estate agent name. So I'll put Andrew Finney.
Love it. I know him.
I know him. He's fantastic. Here it's just going to ask you a little bit about the home. That's okay if you don't know this information, because we're just getting you pre-qualified. Just go ahead and select anything. I usually just select single family residence until we figure out what type of home you're going to purchase. The occupancy type is important. We need to know why you're purchasing the home. Are you purchasing the home to live in as a primary residence, or are you purchasing the home as a second home or a vacation home where you're only going to live in it maybe a few months out of the year? Or is this an investment property? Are you going to rent it out? You need to let us know what you're doing. In this case, we're purchasing our very first home to live in full time. So the application is going to ask you about your banking information. We need this information to verify the assets for your down payment and or closing costs. So today we're banking with Happy Bank.
Love it. Happy Bank, positive mojo.
Yep, and it's going to ask for your balance in your checking account. Right now, we only have $1,000 in the checking account. Then it's going to ask for the name of your savings account, also with Happy Bank. And in there we have $14,000. If you have any 401k or retirement accounts, any other sources of assets, you can go ahead and put those here. We don't necessarily even have to use those to close on your home loan. As far as, cash to close, we don't necessarily have to use this, but you might just want to show it on your application just to show that you have reserves or money that you can tap into should you have a rainy day. So if you want to, you can always show off here and add additional accounts. So this next section is a bunch of yes or no answers. They kind of look scary, but they're not that scary. It's going to ask you if you have any outstanding judgments. In this case, we don't. Have you had a bankruptcy within the past 7 years? No. Have you had a foreclosure within the past 7 years? No. Are you a party to a lawsuit? No. If you are, that's okay. Just go ahead and select yes, and your mortgage loan officer will go over your options with you. Another question, any loans that resulted in foreclosure or judgment? In this case, no. Are you delinquent or on default on any federal or state debt?
Would that include, I'm sorry, but when you say about federal debt, would that include like any federal student loans?
Yes, so we do look, do you have any student loans and collections? And just depending on the loan program, we'll follow the guidance. So if you do have, student loans and collections or that are charged off, then, some people select no, and that's okay because we're going to see it on your credit report regardless, and your loan officer can update the application accordingly. So if you make a mistake on the application, don't freak out. Sometimes I get a lot of people are like, oh my God, Celeste, I chose the wrong thing on the application. I'm like, it's okay. Once I get it, once it pops into my queue, I can go in and alter the information. I can change it up and correct it. Okay. It's going to ask if you pay alimony, child support, or separate maintenance. Maybe in this case, yeah, I pay child support. So we're going to go ahead and select yes. It's going to ask you, have you co-signed on anything? On a loan? Did you co-sign for someone's car? Did you co-sign on a dentist bill? If you co-signed on anything for anyone, you're going to select yes. If you have not co-signed, you're going to select no. It's going to ask if you're a U.S. citizen. If you're not a U.S. citizen, that's okay. Maybe in this case, we're not a U.S. citizen, but we are a permanent resident. It's going to ask if you've had an ownership interest in a property in the last 3 years. If you have, then you select yes, and that just means you're not a first-time home buyer. If you have not, you select no, and that means that you are a first-time home buyer.
So with the ownership interest, just real quick, if you said that you had ownership interest in a property, let's say that somebody had a parent that willed them a property and they have a sibling, they have a brother or sister, right? And the property became theirs as a joint property. Now they have ownership in a property, even if they've not yet bought a home and they would have been a first-time home buyer otherwise. What happens in that situation if they now own this property in like a joint tenancy situation with a sibling, but they themselves never bought a house? Are they still considered a first-time home buyer or not?
It just depends on how it's documented. I mean, if we're searching and we can see that you own this property or on the title of the property, then in that situation, you would not be a first-time home buyer because you have an ownership interest in a property. Okay. You own that property. But, maybe you're not on the title and maybe it doesn't show up, then, we could probably get you through as a first-time home buyer. And in that situation, I would say just get all the documentation over to the loan officer, have the loan officer verify everything, and just see what your options are. It doesn't hurt to take a look into it. Because we don't want to just find out, in the middle of the transaction, like, oh no, you're not a first-time home buyer, and now maybe you have a little bit higher of a down payment than we thought you had. So definitely get it all squared away before you even go out and start making offers.
Good stuff. Thanks for the clarification.
Yep. So in the previous section, we answered yes, we pay either alimony, child support, or separate maintenance. We don't pay alimony, so we'll just put 0. But, oops, we missed this question. So if you miss a question, it'll just pop it back up. We are a permanent resident, yes. Because I selected no, we're not a U.S. citizen. So yeah, so just depending on how you fill out the application, if you answer yes or no, it'll pop up certain questions throughout the application, but you can see that it's pretty user friendly. So this next section is answering questions about demographics. So this section is basically it's for government monitoring purposes. It does not affect you or your loan application. It's really the government monitoring us as mortgage professionals. They're making sure that we're providing fair options and loan terms to everyone, regardless of race, ethnicity, or sex. So you can go through here and just click what your ethnicity is. If you're Hispanic, you'll click Hispanic.
You also reserve the right not to answer. That's also
yeah. So you don't have to answer this information, but your loan officer legally still has to guess based on your surname. So just keep that in mind. If you see something selected on the application, it's because your loan officer did have to guess what your ethnicity, race, and sex is. But just know if you do fill this out yourself, it does not affect you qualifying for the mortgage loan at all. But just, the options for ethnicity: Hispanic, Latino, Mexican, Puerto Rican, Cuban, other, not Hispanic, or I do not wish to provide. In this case, I'm going to select Hispanic and Latino because I look white, but I am Hispanic. For my race, the options are American Indian, Alaska Native, Asian Indian, Chinese, Filipino, Korean, Japanese, Vietnamese. There's so many different options: African American, Native Hawaiian. So you just select what applies to you. In this case, I'm white, so I'm selecting white. For the gender, the options are male, female, I do not wish to provide, or you can select both, whichever applies to you. Hit save and continue. If you have a co-borrower on a loan, maybe you're applying for the loan with your spouse, or maybe you're going to have a co-signer or a non-occupant co-borrower, they would go in this section. You would just select yes, and they would go through all of the same steps that we just went through. In this case, I'm applying for the loan all by myself, so I'm going to select no, hit save and continue. This next section is just asking for us to e-consent. This is really important. If we don't have an e-consent from you, we have to send you your loan disclosures through the snail mail, so through USPS. If you e-consent, that means that we can send you your important loan disclosures to sign through email, and it's a lot faster and it's really user-friendly. So I always tell all of my clients to please accept the e-consent agreement in your loan application. So you can just select, I agree to consent to do business electronically and to view loan documents electronically. So hit I agree. And that's it. That just brings us to the page of where you can submit your loan application. If you want to, you can review your loan application, and it just shows us everything that we did. If you need to make any changes, you can make changes here. But if everything looks good, go ahead and just submit that loan application, and you're all set. It's easy as that. 1, 2, 3.
Pretty much. And thank you for doing that, because I know that sometimes, again, people do get nervous. And now, hopefully, we just did that hashtag Beyond Fear. We moved beyond false evidence appearing real to show you exactly what a real application looks like, courtesy of Celeste walking us through. And it is also important to note when it says start your checklist that the next thing coming up is that we need to get hot on verifying your income, assets, credit, and employment. So that would constitute your last 2 years tax returns, 2 months of your bank statements, 1 month of your pay stubs, plus a copy of your driver's license or otherwise government issued identification card. And then any other documentation that you would be reviewing with the lovely Celeste Harvey or loan officer that you're chatting with about your home loan options. So it's important to note that. Now, Celeste, really, really appreciate you breaking that down and walking us through. I know that this is going to help a lot of different people that watch this. And if it's helping you, then please let us know what your key takeaway was in the comments. That'd be great to hear from you. A couple of comments that came in. We had Micah that was asking about the rate. And Micah said, oh, the reason for my question was due to being told that 2.5% was the lowest I could pay down to, not allowed to pay any more points. Is it ever possible to pay points down to a 0% interest rate or near it? Boy, oh boy, Micah, I love your question because, I actually asked a very similar question once upon a time, and I'm going to let Celeste give us that answer.
So hypothetically, if you could pay it down to 0%, man, that would be really expensive. But yeah, I mean, there's usually a certain threshold, and it's all dependent on the market. When we're looking at mortgage interest rate pricing, it only goes so low. So it really just depends on the specific mortgage company and your specific qualifications. But if your loan officer is telling you that 2.5% is the lowest, then that probably is the lowest that you can buy it down to, especially for a 30-year fix. Now, if you're looking at a 15-year fix, you probably have more room to buy it down below 2.5%.
Good stuff, Celeste. Thank you so much for that. And Micah, I hope that helps answer your question. Now, I also saw a question come in from Trend V. Now, this is an interesting question, Celeste. Trend says, hello, Andrew and Celeste. Curious, can I get out of a contract via a financing contingency if I am approved for a home loan, but I do not like the rate and terms? Will the lender give me an unapproved letter? I have an answer from the real estate side, but on the lending side, would you like to take that on?
Well, in my experience, I'm going to go and say, no, I don't think that that the underwriter is going to deny your approval based on not liking the rate or terms. For them to give you a loan denial, it usually has to go through 2 different underwriters, and they really have to dot their I's and cross their T's and verify the reason why you do not qualify for the mortgage loan. And one of the things is when you signed your initial loan disclosures, everything was stated to you in the initial loan disclosures, your loan term, about what interest rate you're looking at. If it's floating or if it's locked, it would have stated that it was locked. It'll state the loan program. So if you had any issues with the loan terms or program, it should have been stated, before you signed your initial loan disclosures or before you went past your due diligence period. But once you're past that due diligence period, it's going to be really hard to get out of the contract, via the financing contingency, unless you really just don't qualify for that mortgage loan.
It's a great point, and I'm glad that you brought that up because in my experience, and I've gone through this rodeo just over 170 or so times over the last 6.5, almost coming up on 7 years here in a couple months or so. But that said, I think it's really important to note that because in a purchase agreement, there are several different contingencies, several different windows where a cancellation or something that you essentially have just what it sounds like, a contingency. Now, a financing contingency is one of those considerations in a purchase agreement, and generally it's dictated by a certain amount of time. So like here in Vegas, we close homes on average in 30, 35 days and faster. But for the purpose of writing an offer and going through like negotiation phases, typically when I represent a buyer, I'll be looking at somewhere between that 30 to 35 day window, depending on the day that we're writing it. So if we're writing an offer like on Friday, I know lenders and title don't work on the weekend. So then I'm automatically saying, hey, we're probably going to negotiate over the weekend if it comes down to that. And even if, Rockstar, they just accept the offer, we can't open escrow until Monday. So I begin that clock as of the date that the lender would receive the purchase agreement so that they can begin working on your home loan with you. The reason I bring that up, Trent, is because when you look at these contingency timeframes, typically what I would do is be writing in a 21-day appraisal contingency, meaning that the value of the home has to check out in 21 days or less. We need that report back. And most time we have it back well before then, but that's a safeguard just in case. The financing contingency can realistically drop within 48 hours or sooner of that appraisal contingency. Once they got it back, she can submit it to final underwrite, start clearing out the financing considerations, because now up to that point, they've already been working your file and they need the validation of the appraised value. So the financing contingency would drop at day 23 in this case. So you have to, number one, know what the contingency timeframes are within your purchase agreement, which is spelled out. Like here in Vegas, where our purchase agreement is 10 pages, for example, and it's specifying all these different contingency timeframes and such. Now, just because a buyer doesn't like the rate or the terms, if it does not financially disqualify them, then from my experience, that also means that contingency is not one that you're going to be able to back out on, because a lender will not, or it cannot, issue a loan denial letter because a buyer decides that they don't like a rate or like a term. So it's important to note that and just be honest with it. I would ask you, Trent, if that is your situation, to please gain clarity by asking yourself again, why did you want to buy a home? And in specific, that house that you made an offer on out of all the other ones that were available. What were your thought processes with your initial loan disclosures and your loan estimate that your loan officer would have provided to you early on in the process? What has changed? And gain clarity on how that's going to impact you, because the reality is, in this situation, it doesn't sound like it would be very probable that you could back out. That may not be the answer you want to hear at the end of the day, Trent, but that is an honest answer. So Celeste, thank you for sharing that. Trent, please revisit and gain clarity on why you were buying a home and what was important to you about that, and help you better understand the situation at large. So I saw some more questions come in. Rebecca Quintana says, yes, thank you. Miss Rebecca, thank you for joining us. Eugene says, good morning, Andrew and Celeste. Good morning, Eugene. Which mortgage option, a 30-year versus a 15-year, would you recommend if I plan to buy a house and stay for a minimum of 5 to 7 years before moving to the next move? I also plan to put more money into the principal on a monthly basis if I were to opt into the 30-year term. Great question. Really appreciate the question, Eugene. And in short, if you're looking at a 5 to 7 year, the real trade-off here is going to be how much home loan you're going to be able to get, depending on your debt to income ratios. And if you're able to find the home that's right for you on a 15-year, awesome. If you're not able to do that and you need the 30-year term to be approved for the purchase price that you're looking for, then that's also a factor. Now, it doesn't hurt you to go the 30-year option if you're looking at the 5 to 7 year. But one thing to keep in mind was the illustration that Celeste shared with us earlier today. Let's say that all things are considered equal and you can get approved for the amount of home that you want. Now, earlier today in the stream, Celeste shared with us the very real trade-off of how much money is going to your principal versus your equity, the interest payments in the first 5 years. Now, you specifically said 5 to 7 years. Celeste example that she had up for us earlier was specifically the first 5 years based on so let's put it up so that I can show this real quick, please. It'd make it a lot easier.
There you go.
Whoops. Did I take it off? Okay, let me put it up.
There it is.
There it is. There we go. Okay, so what we're showing right here is that 5-year paid equity, right? So equity, please understand that when we're talking about paid equity, that's money that went onto your principal balance, not just to the interest. A difference between the 30-year and the 15-year here is that you would have only had $30,000, almost $31,000 go on to your principal balance in the same 5-year period, whereas you'd have almost $83,000 that went onto your principal balance in your 15-year. The reason this is important, Eugene, is because when it comes time to make a move, let's say that you're going to sell that property, take that equity out so that you can either invest it or use it for the next house, right? Or maybe you want to rent out that property. All of those opportunities are going to be yours. And the important thing is that you'll have the option when the time comes. But the moral of the story here is if you could get approved for the amount of home that you want on a 15-year and a 30-year, then I would probably go the 15-year route if that made sense to me from the monthly cash flow position, because I'm going to have more equity in my home faster. I'm paying less interest over time. And in a 5 to 7 year period, when it comes time to sell my home, ideally the real estate market has slowly appreciated, and you're going to have that equity position from the real estate market, but you're also going to have the equity position from what you've already paid onto the principal balance itself. So that would seem to make a lot of sense. It just really comes down to what your situation is and what's going to make most sense to you. And it's really going to come down to two things. Number one, it's going to come down to how much can you get approved for, Eugene? And is that going to be the right type of home for you? And number two, what is your cash flow position on a monthly basis? And is it comfortable to you? So that's all I've got on that. Celeste, what are your thoughts?
You hit the nail on the head. I mean, it really comes down to what you qualify for with a 15 versus a 30-year. Comes down to, are you comfortable making a higher mortgage payment, or would you prefer to make a lower mortgage payment and then have the option to pay extra payments towards the principal? I feel like you have a little bit more control with a 30-year. It's just a lot more affordable, and you can choose to pay more down, or you can choose to go with the minimum payment. And you only plan to live in the home for 5 to 7 years. So I think you really just can't go wrong either way. It just really it always comes down to, can you afford the payment?
Yep. I think it's a great opportunity. Eugene did let us know. See, I got so excited by answering the first question. He did let us know, hey, I'm going to put extra money onto the principal, even with the 30. So then, yeah, you can do the exact same thing. Just know how much of a mortgage payment you would have on the 15-year level. And if you opt for the 30, then just apply the difference of what those payments would be directly into the principal balance, and verify that it's going to your principal balance as you're paying off your 30-year fixed rate mortgage faster in that case, okay? Because then you would likely still be able to enjoy the same equity position that you're paying for as the 15-year. And then you'll have the safeguard that if for some reason life threw you a curveball, and God forbid that it does, and let's just put positive emoji that it doesn't happen like that, but let's say that it did, then the contingency plan would be that you already have the 30-year mortgage at a much more comfortable level than being locked into the 15-year in that case. And you can regroup yourself and then stop making the extra payments if that was life situation at that time, and still comfortably pay your mortgage. So there's a lot of ways to look at this, and it really comes down to what's most comfortable to you. I love the fact that you chimed in today, Eugene. Thank you so much. Very rock star of you, because this is an important question, and it's one that I hear a lot across the channel and comments. It's one that people ask me directly, and I know that Celeste gets asked this question a lot too, about breaking down the differences, and that's why we wanted to have this robust conversation with y'all today. So thank you for the good stuff. Celeste, any parting shots on that, or shall we move on?
I think we covered it. If there's anything we didn't cover, Eugene, just let us know.
Perfect. Jonathan Graham says, hi, Andrew. I was approved for a loan at a 3.125% interest rate. That's really good. Do you think rates will continue to drop, and what impact do you see COVID-19 on rates and housing cost? I'm wanting to buy within the year. So Jonathan, that's a loaded statement and loaded questions, and it's really good. And I appreciate you loading it up. So let's go ahead and chamber those rounds and start answering those questions, right?
Hey, Jonathan. Hey, that's a really, really great question. 3.125% rate is phenomenal. That's an amazing interest rate. As far as if I think interest rates will continue to move lower, no one really knows. There's no way for us to time the market. There's no way, we don't have like this magic crystal ball that lets us know. If we did, I'd probably be working on Wall Street, making a lot of money. But what we can do is, based on the knowledge that we have, is try to make some educated guesses based on what I said about, the Fed stating that they're going to continue to purchase treasuries and mortgage-backed securities at the current level that they're purchasing them right now. Just indicates that, the mortgage market should remain somewhat stable for the foreseeable future. Do I think mortgage interest rates are going to move much lower? I don't think they're going to get too much lower than they already are, but hey, anything is possible. But just keep in mind that there's a lot of things that affect mortgage interest rates. I mean, any statements made by the Fed, any information that comes out about COVID-19, maybe a second wave of cases coming through, can impact the market, or maybe any information about a treatment or a vaccine coming to market earlier than we expected could cause a movement in interest rates. Anything that happens with the bond market or treasuries impacts mortgage interest rates. But another thing we have to keep in mind is if mortgage lenders hit capacity again, and if we see margin calls, that could cause volatility like we saw back in March, where interest rates were 3% and then 4%, and then we saw 5%, and it's just every mortgage lender was pricing all over the place. I would say if you're thinking about purchasing a home, you should purchase a home when you're ready to purchase a home. I wouldn't purchase a home just waiting for the perfect interest rate, because that may not materialize. We don't know.
I think those are great points, and I appreciate you diving deep into that, because one of the things that occurs to me, or one of the thoughts that I have behind this, and please correct me if I'm wrong here, Celeste, because I'm just a human and I'm a student of life like everybody else, right? So what it seems to me in real estate practice and watching and working with you and Bill and with Homebuyers so often is you really have two things that come into a rate. You actually have several more, but I mean you can really bullet point it into two categories. You have what would be called fixed facts. In other words, what can be controlled in somebody's life, right? And then you have the unknown facts, the variables, right? Like everything that you just mentioned are variables that have a direct impact onto a mortgage interest rate. But I think it's really important to note, because just because you see somebody saying, hey, you can get a 2.5% or 2.75% rate or something along those lines, doesn't necessarily mean that when someone does their application, they can expect the same if they are not meeting those rules and the terms and conditions. So that's what I mean when I say like the fixed part, the part that is known, the part that we control. In other words, what is your credit score? In other words, what is your debt to income ratio? In other words, what loan program are you qualifying for, and can you qualify for it? And did you opt for like a down payment assistance program, which will definitely increase the rate, because that's how those programs get paid for. So, I mean, it's very important to take stock of all of that, because when you click those little asterisks online and you say, hey, they told me they give me a 2% rate, and you're like, oh my God, I want it. And then you click on it. And then if you look at that little asterisk, they say, hey, this was for friends and family members only of this banking institution, assuming a 20% down payment on a 5-to-1 adjustable rate mortgage with an 800+ credit score. Terms and conditions continue to apply, right? So that's the reality. So we got to take in the known variables about how strong your economic and financial health is with yourself, which is something that you and all of us individually control. So we got to take personal accountability and ownership for keeping our own fiscal house in order, okay? Because everything that Celeste shared with us are things that change based upon factors outside of our control. Now, one of the ways I always work on keeping my mindset right is to focus on the things that I can change, right? Which constitutes this person right here. This person right here I can control. So it's really important to take stock of that, because we can only control what we can control, and it's always ourselves. We can't control what somebody else is going to say and what someone else is going to do. But if we focus on those things that we can control and we do the best that we can, then we can expect the best of the best when the time comes. And to Celeste's point about the timing of the market, I think it's incredibly important to always buy a home when it makes sense to you in your life. Don't buy a home based upon the market. Buy a home whenever the time makes sense to you for the reasons that are important to you at the right time in your life, and then get the best deal that you could potentially get in that market. In this case, and we have historic low interest rates. So people taking advantage of this are going to have that great opportunity to cash in on those low interest rates. And that's an amazing opportunity. When you ask me about housing costs and stuff on the second part of your question, Jonathan, it's a great question. Now, realistically, I think we're going to just keep balancing the way that we saw in 2019. And we've seen now, prices actually went up. Home appreciation actually went up during the stay-at-home time in April. Okay, so we can say, well, that could be attributed to all the people on escrow that was closing in April, whenever in reality they were in contract through the month of March. It's a good consideration. So we got to keep watching what happens there. But ultimately, economists that do nothing but nerd out on these numbers even more than I do, because they're economists and I'm not, I'm just a humble real estate agent, right? just student of life and student of the market. The reason I bring that up is you have different consensus depending on the economists saying that, hey, might see a home depreciation around 2 to 5%. Worst case situation. And then it's like everything else. Here's option 1, here's option 2, here's option 3. But then you have other ones like a Zillow group, for example, that say, hey, we forecast a 1.8% home appreciation by the end of 2020. And this is being published after the COVID-19 announcements and impact on the economy. So it's important to take stock of that. To the people that like to continue believing there's going to be a huge amount of foreclosures, I do get irritated because Celeste and I have been out on Livestream and we have published facts and we have put forth the information to share with you why it's highly unlikely for a host of reasons, beginning back in 2012 and 2013 with President Obama, the Dodd-Frank Act, the CFPB's formation, and lenders having to meet the muster now, and people that were buying homes having to meet the muster of debt-to-income ratios and actually qualify and demonstrate the ability to repay the loan. And then last week's live stream with Celeste, she hooked us up with some inside great info right there. Out of 124 million homes that are single family homes throughout the United States, there was roughly like 40 million, if I'm not mistaken, that were being used as rental properties, 80 million that have actual primary owners inside the home. Out of those, it's like 43% of them own those homes all out, no mortgages. Of the remaining 50% over, what was it? I'm sorry, was it like 50, 60%, 53%, I think it was, that actually have 53%, I believe it was, that actually have an equity position in their primary home of $177,000 or greater. So then that would realistically leave you, if you start doing that math and start subtracting out all these numbers, it would leave you with potentially 25 to 30% of the market that could be impacted. But then you got to look at when they bought their home, and then you got to look at all the different vehicles and legislation that have been recently passed, including mortgage forbearance, how a loan deferral works, how loan modification works, and the complexity of what it is to actually get short sold or foreclosed upon. Now, if you received a notice of default, like not you, Jonathan, because we're talking about helping you buy a home, but this answers your question and what goes through my mind whenever I share things about housing cost and market predictions as best as can be discerned this time looking forward, keeping in mind that 2020 is hindsight, right? When we look at the trends, indicators, and conditions, in other words, what makes the market tick, TIC, trends, indicators, and conditions, and we look at these indicators and we look at these trends and we take into the account these facts, it becomes incredibly apparent that a lot of people, even aside from the 53% of people that do have mortgages, having an equity position of a very strong 6 figures of $177,000, that's a lot of money. But that said, a lot of other people also have equity position in their home. And if you knew somebody that was going to get foreclosed on, why would you not just put your home on the market and sell it prior to getting foreclosed on, take your equity out of the property, regroup, rebuild your life? And look, frankly, that would suck. I love my house. If I had to sell my house right now because of the same type of situation, I'd be devastated. It would hurt my feelings because I love my house and I put my heart and my soul into my home and making it just the way that I want over the years that I've lived there with the renovations. It would hurt. But you know what would hurt worse? A foreclosure. And what hurt us bad is cashing out all the equity that's in that property and rebuilding my life and getting going in that direction. That's the reality. And that's the truth that you don't hear a lot of people talking about that needs to be discussed, because that's the reality. It's also something I was chatting with Bill yesterday about, Celeste. I actually need to check with my mortgage service provider, because the other day I was in my account and I was like, I don't know that they took my mortgage out. And I do an auto deduct. I was like, why wouldn't you take my mortgage out? Uh-oh, did you automatically forbear me even though I didn't ask for it, call you, or even inquire about it? Oh, that will really tick me off. But the reason I bring that up is that I'm in a position that I can pay my mortgage. I want to pay my mortgage, and I want to keep paying my mortgage. If I was automatically put into forbearance, it'd fall into something that Celeste has shared with us in the last time we were talking about forbearance. How many of those 4 million estimated people, I think it's 4 million, or is it more than that, Celeste, that are currently
I can't remember. I have so many numbers in my little brain, but there was a chunk of people who were placed in forbearance by mistake. Maybe they were just calling to get information,
learn what it is,
what it's about, and they didn't intend to sign up for a forbearance, but the servicer just placed them in it anyway. So there are some people, who are not supposed to be in it.
Right. And that's the point, is out of X number of millions of people, let's call it an X quantity for math, right? Let's call it X number of people that are in forbearance. How many of them are knowingly in forbearance or meant to be in forbearance? Okay. And that's when we start looking underneath and we start peeling this onion back. Now, we got to peel it back so we can understand every one of the layers that are likely to be seen going forward. And when people say, hey, you know, I just know it in my mind's eye because this is the mojo I'm putting out there. The market's going to crash and I'm going to make good and blah, 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 right? It's drinking Kool-Aid. And to put it in context, if you don't know what Heaven's Gate is, then please research it. Essentially, you're going to kill yourself if you drink that Kool-Aid because it's poisonous. It's self-delusion. And that's where the facts come into play. And that's one of the big reasons why you have over 650 videos on my YouTube channel. It's one of the biggest reasons why we resumed a live stream format about third week of March, third week of March, was to help everybody make sense of this. So when you ask those questions about housing costs and when you're saying you want to buy within a year, my suggestion to you, Jonathan, is to get clarity on the reasons why you're buying a home, how it's going to impact your life, how long you want to live there, and make the decision that's right for you based upon the factors in your life that make sense to you at the time that it's going to make sense to you. Because right now, we know what we know. Tomorrow, we don't necessarily know. But we do know where the trends, indicators, and conditions are headed. Real estate looks like we're going to remain strong. Will we see correction in the market? Of course. Whether it's up or down or whatever, we're going to see something. Because markets go up, down, and all around all the time. But what doesn't change is what's going on in your life at a specific time. So that's where I'd ask you to put your situation in context. I hope that helps. That I really do. Let me see. It looks like Kathy. Oh, hang on. Whoops, wrong one. Okay, Micah, thank you so much. Micah says, thanks for the insight. Love the Friday broadcast because work is slower on Friday, so I have time to listen in. Thank you for listening in. Really appreciate you being here and your support, Micah. Kathy says, I agree, and just in case you can't afford to pay extra, you don't get in trouble, in reference to our conversation with Eugene. Mm-hmm. Because a lot can happen in 10 to 15 years. Oh my goodness, are you right about that? Life can really change in a decade and a half. That's for true. Okay, Eugene says, sorry for the repeat questions. If it comes up twice, there was a typo and I wanted to retract the message, but it seemed like it went through. Yes, sir, it did. And thank you so much. And that's really good stuff. So, you know, I really appreciate everybody joining in today. Celeste, do you have any final thoughts as we get ready to adjourn? We've been streaming for almost 80 minutes.
Final thoughts. I just want to remind you guys, if you need assistance with a purchase or a refinance, I am licensed in California and Nevada, so I can help you personally. If you are refinancing or purchasing in a different state, I can always put you in touch with a mortgage loan officer in your state.
Good stuff, Celeste, and thank you for being here. We're happy to have you. And as always, everyone, you know, I really hope that you've learned a lot from the stream and it's been very helpful to you. And if you're still with me at this point, whether you watch live or you're watching this after the fact, thank you so much. Really, really appreciate you. And I'd ask you to remember that we are all stronger and better together than we are not. We can make this world a better place if we remember to be the reason someone smiles today. Now, please, I hope this has made you smile. You go out there and enjoy yourself a beautiful weekend, and we'll see you next week.